Good day, sir. Thank you for giving our group the opportunity to present our project. We are pleased to share the outcome of our efforts. For this presentation, we have selected case 3 and case 5, as we believe they offer valuable insights and align well with the objective of the assignment. We look forward to sharing our analysis with you and appreciate your time and attention. So this is our member group. First is Jeni Meliaberta, and the second one is Shellonita Vilanova, and the last one is Tiara Berliana. And so let's go to case 3. Check it out.
So this is the case 3, financial ratio evaluation. This is the given question from company financial report, the following. The current asset, which has a 2 billion rupiah, current liabilities 1 billion rupiah, the net income is 1.2 billion rupiah, the equity is 4 billion rupiah, and the sales, which has 6 billion, and last they has the COGS, or aka cost of goods sold, 4.2 billion rupiah. So the given questions here are: first, calculate current ratio ROE and the gross profit margin. Secondly, we got to interpret the following: the company's liquidity, profitability, and efficiency. The last questions given is benchmark to industry standard. Assume average ROE is 18%. So here's the breakdown for the questions. Number 1, first we get the current ratio. So the current ratio formula is current asset over current liabilities. The given above already has 2 billion over 1 billion rupiah, so the total is 2.0. And now we move to the ROE is equals to, the formula is net income over equity times 100. The given is net income has a 1.2 billion rupiah and the equity has 4 billion rupiah. So 1.2 billion rupiah over 4 billion rupiah times 100, which is the result is 30%.
And combined leverage DCL equals DOL times DFL, we got 2.66. Strategy B.
So for the last, we got the gross profit margin. The formula is sales minus COGS over sales and times 100. So the given are following: sales revenue has 6 billion rupiah and the cost of goods sold, or COGS, is 4.2 billion rupiah. And here's the breakdown. So gross profit margin is equals to 6 billion minus 4.2 billion over 6 billion and times 100. So we got the 1.8 billion rupiah over 6 billion times and 100. For the second question, that's about interpret the gross profit margin, profitability, and efficiency. So here's the answer. For the liquidity, or current ratio is 2.0. Liquidity tells us how easily a company can pay its short-term bills. For the company, financial has twice the amount of current assets compared to its current liabilities, meaning to say that it should have no trouble covering short-term expenses. This is a strong financial position, but having too much cash sitting around without investing, it might mean missed opportunities. And for the profitability, or ROE, is 30%. Profitability shows how well a company makes money for its investors. For the company, financial earns of 30% for every 1 rupiah of shareholder investment. So this is higher than the industry average, which is 18%, meaning that the company is performing well and efficiently using its resources. So investors would like to see this as a great return of their investment. For the last, efficiency, or gross profit margin 30%. Efficiency is not is about managing cost while still making money. So the company financial keeps 30% of its revenue as a profit before other expenses. Means that it has a good control over cost and pricing, making it competitive in its industry. Keeping this number strong is key to long-term financial health. For the last questions of case 3, benchmark to industry standard, assume that average ROE is 18%. So here's the breakdown. Benchmark of company financials, ROE against the industry. So for the company financial ROE is 30% and the industry average ROE is 18%. And so in here, the company financials ROE or return on equity is much higher than the industry average. This shows that the company makes more profit from the money invested by the shareholders compared to the other companies in the same industry. So we could say that in conclusion, because the financial company ROE is higher than the industry benchmark, it is a strong financial position and more attractive to investors. However, the company must maintain this performance by continuing to invest wisely and manage costs effectively.
Case 5, operating versus financial leverage decision. A logistic firm is analyzing two expansion strategies. Strategy A, high automation, fixed cost equal high. Strategy B, outsourcing, variable cost equal high. Text, compare the OL and the FL for both strategies. Recommend the more relevant model under sales uncertainty. Use example data. Sales 10 billion, VC 6 billion, FC 2 billion, interest 500 million. So first we calculate EBIT, formula sales minus variable cost minus fixed cost. Strategy A, EBIT 10 billion minus 6 million minus 2 million equals 2 million. Strategy B, EBIT 10 billion minus 8 billion minus 500 million equals 1.500 billion. Next, we calculate DOL, formula sales minus variable cost divided by EBIT. Strategy A, DOL 2, strategy B 1.33. Next, we calculate DFL, formula DFL equals EBIT divided by EBIT minus interest. Strategy A, we got 1.33 and strategy B, we got 1.5. So the conclusion and recommendation: strategy E, DOL 2, DFL 1.33, and strategy B, we got DOL 1.33, DFL 1.5, and combined leverage we got 2. So strategy A has higher operating leverage, meaning higher sensitivity to sales changes. Strategy B has lower fixed costs and lower total risk. Therefore, under sales uncertainty, sales strategy B is more resilient and stable. Recommended strategy: choose strategy B. Lower leverage means better protection in uncertain sales environments.
The last one is thank you for the opportunity. We look forward to presenting our work. Thank you, sir.